Okay, this chapter we're going to talk about accounting for income taxes. Probably my least favorite chapter out of the textbook, going to be honest with you. But again, something that we have to talk about. We won't actually do taxes. This isn't a tax class, but you have to understand that there's a difference between the income that we record on our financial statements and then the income that we record to the IRS on our tax returns. So then we have to be able to account for that. So then what there ends up having is there's temporary differences and then there's permanent differences. So temporary differences is just timing. So it's something that we're going to deduct on our financial statements, and we're also going to deduct on our taxes. But sometimes the tax, like think of we're buying a big fixed asset, we're buying a new truck. Tax may let us take that entire deduction the year we buy it. On our financial statements, we are not going to want to do that. We're going to depreciate it out over its service life to properly match the expense to the period that uses it. So that creates a temporary difference. The IRS also says if your customers pay you in advance, then you need to record that as income when you receive the cash. Or on financial statement purposes, if we haven't earned it yet, we're not going to record it. So that creates a temporary difference. Warranty work. If we're going to record that liability when we know that we possibly could have it, again, trying to match it to the revenue, but then the IRS says, well, you can't deduct that till you actually perform the warranty work. So all of those types of things are the temporary differences. But I admit it gets kind of confusing when you start looking at these things, but try to think like big picture. So here is that example of, say, an asset we purchased for $60,000. From a tax return standpoint, we are going to write the whole thing off the year that we purchase it. So that whole $60,000 is going to reduce our taxable income, and then we're only going to pay taxes on that amount. So we'd owe $15,000 to the IRS. Now on our income statement, we're going to take that $60,000 and amortize it out over its life. So in this example, 3 years, and our net income would be $100,000 each of those years. Now then the next year, though, like if you're going year by year, then the next year we're going to have that $20,000 depreciation deduction. We will not have it on our tax return. So then there'll be a difference between our taxable income again and then our book income. But over time, you can see that we're going to end up, writing off that same amount on our taxes. It's just when do we write it off? You know what I mean? We're going to write it off earlier so we get the tax advantage earlier. So what that ends up creating, though, is what this slide tells you. You either get a deferred tax liability or you're going to get a deferred tax asset. So, again, depends on which way it goes. So if it's if it's going to create a future taxable amount, we would create that deferred tax liability. If it creates a future deductible amount, we would have a deferred tax asset. So we'll go through, and then your tax expense, is always going to be reported on your income statement. And we're going to see that that ends up being like a plug number between what is payable and what is in these deferred tax liabilities and these deferred tax assets. So that's what this next slide says. Okay, our tax expense is a plug because we are going to first figure out what is our tax payable. So this is the amount that we have to pay when we file our current tax year return. Then we're going to calculate these deferred tax assets and these deferred tax liabilities. And then we're going to calculate any change between the 2 years, from last year to this year. And then the difference is going to be our plug number, and that's going to go to income tax expense. So again, this is a good slide. I would print this out or write this stuff down. Because then when you go to do your homework, you'll have examples of each one of these. It possibly will feel redundant, but they're different types. They're different accounting transactions. So we've got revenue that is reported on the income statement now, but we're not allowed to put it on our tax return until later. So we've got installment sales of property, unrealized gains from our investments that we have not sold yet, but we have to record the gain if it goes up. And then we've got down below, again, if I stick with the revenues, if what we have to report on our taxes, but we won't report on our income statement right now, is things what we collect in advance. So notice all of these are income that comes into us in advance. Generally accepted accounting principles says, hey, we can't record that till we earn it. IRS says, but you got the cash, so it's taxable to you now. So that will create a difference. Then on the other column are expenses. So expenses that are reported on our income statement but not on our tax return are going to be any estimated expenses that, like, say we know we have a lawsuit coming up and we know that we're going to owe or something like that, but we haven't paid it yet. Well, we can't deduct that because, again, we haven't paid it. Unrealized losses, so the flip-flop of the investments. If we have an unrealized loss, again, we haven't sold it, so it's not taxable until we sell it. But following generally accepted accounting principles, we make our investments at market value. Then down below, again, if we have the depreciation, so we buy an asset and we accelerate the depreciation, or we take a Section 179 and we deduct the entire amount the year of the purchase, and then following our generally accepted accounting principles, we depreciate it out over its life. Or prepaid expenses, we may pay for a year's worth of insurance in advance, and we can deduct that because we paid it, but on our financial statements, we're going to amortize it out as we use up that insurance or as time passes. So these are all good examples to look through because, again, it's going to help you when you go to work out the problems on your own. So again, it's that same example, though. We purchased a $60,000 piece of equipment, and we are going to write it all off in the year that we purchase it from a tax standpoint. So that's our depreciation expense on our tax return. Then on our books, we're going to amortize it out over its 3-year life, which would be $20,000 for each of those years. So in that year of purchase, we're going to have a $40,000 temporary difference that will wash out over the next 2 years. So when you get to the end of those 3 years, there is no temporary difference. It's gone. But then we need to record that. So then if we look here, our journal entry is, let me make sure. Why do I feel like I'm missing the bottom part of that slide? Which is unfortunate, but I feel like I am. Okay, so I will kind of go through. Maybe we're going to go step by step, Jose, because I feel like looking for the debit, but I guess we're going to go step by step. Sorry. Okay, so then we're going to say, okay, as we file our taxes for this year, we have probably $1,000, but 60 taxable income times our 25% tax return, we owe the IRS $15. So that's what they're filling in there. Then we go to our next thing and we say, okay, we have a deferred tax liability because we still have the remaining 40 that we're going to owe. We're getting the credit now, but we won't have it. We won't be able to take it those next 2 years when we take our depreciation expense. So then we take the $40 difference, multiply that by our 25% tax rate. We've got a $10 deferred tax liability, and then that fills in. Okay, then our third step is the plug. So then we're going to say, okay, we've got $15 or $15,000 that we owe the IRS now. We've got 10 or 10,000 that we're deferring to later. Our expense this year is 25. Now notice also, though, it is 25% of that pre-tax accounting income. So we really know that eventually we're going to owe that. We just don't owe it today. So then in the next year, when we have the depreciation and our taxable income is 120 and we owe 25% of that, we're going to pay the IRS that, because again, we added back the 20 because we can't deduct it again on our tax return. So that's why it's 20,000 or $20 higher. But then we're going to take 1 year out of that deferred tax liability. So then it reduces our income tax expense. And again, though, our income tax expense ties to that pre-tax accounting income times our 25%. Then that final year, again, we get rid of our last, and it's going to basically, again, be that same scenario. So we owe the 30,000 to the IRS. We're getting rid of the 5,000 that's left in that deferred tax liability, and the offset goes to our income tax expense. So then that tax liability is gone and it's off of our balance sheet. So it is on our balance sheet. So this kind of showing you those assumptions. We're going to have that deferred tax liability or that deferred tax asset on our balance sheet during that time, again, for those temporary differences. And then we're gonna again amortize that out over its life. Okay, then here's a revenue related one. And in this case, we have $80 million that we have recorded from installment sales in 2024. However, the installment sales are reported on the tax return when they're collected, which will be 20 million in the next year and then 60 million in the year after that, because again, it's like long-term construction, goes over a few years. So then we're going to have that temporary difference of the 80,000 that we are not going to record on our taxes. So our taxable income is going to be 100,000. Then we'll have the difference for each year as the contract is earned. So then our first step is to figure out, well, what do we owe the IRS? So we're reporting $100 or 100,000 of taxable income times our 25%. We owe them 25,000 or $25. Then we determine, well, what's that deferred tax liability? So the difference that we are not recording this year is the whole 80,000. So that times 25% gives us the 20 or the 20,000, and that's going to go into a deferred tax liability. And then our 45,000 is what we charge off to interest expense. Again, it's the plug number to balance, but it's actually probably also 25% times that 180. Let's just double check that. And it is. Okay. Then as that money comes in, then we're gonna slowly get rid of that deferred tax liability based on each year that it comes in. So then here we say, okay, our temporary difference comes out, goes back in. So our taxable income is 120 million at 25%. We owe the IRS 30. Then we're going to amortize out the portion of the deferred tax liability that relates to that 20 million. So that's 5. And then the difference goes to the income tax expense. And again, which would be 25% of that book income or that accounting income. And then the same thing that final year. So then you can see we actually end up, with a 0 deferred tax liability after those 3 years. So again, I realize that seems maybe redundant, but it's a different side. So the one side was expenses that we were writing off in advance, and then the next side was revenue that we are not recording until the cash comes in. Okay, then we have the flip-flop of that. So we can also have deferred tax assets. So those are future deductible amounts that will decrease our tax income in the future. So our first example of that is that we have warranty expense. So we're trying to follow generally accepted accounting principles to match it in the period of the sale, and that is what we are doing. So that's where that 80 comes in. But the IRS says, well, no, you haven't really done anything, and you haven't you've been out any money on these. So then they say when you're out the money, when you actually perform the warranty and money goes out, then you can deduct it. So then that's where then we're going to see those differences come in those next couple years. So then now our pre-tax accounting income is 120, but again, it's reduced by that $80,000 of service expense that we really didn't have. So what we owe the IRS is on 200. So 25% of that is 50. So that's our tax liability. Then the 80,000 times the 25% is a $20,000 or 20 deferred tax asset. And we're going to record that again as a debit because it's an asset. And then our difference is going to be the interest. And again, it's still that pre-tax accounting income times 25%. Okay, then as we actually perform the service work, then we're going to use up that asset. So then we say, okay, we had the $100,000, we actually incurred the $36,000 of expense. So $64,000 is taxable now. So our income tax payable is 16. Then we take I guess you could do this either way. Let's see if I take the 36 times the 25%, that gives me 9. Or they're having you look at it to say, well, what should be left in my deferred tax asset? I've still got 44,000 times 25%, so there should be 11 left. But you could also do it the flip-flop way and say, I used up 36, which is 9, and I'm going to credit my deferred tax asset for that 9. Either way, you get to that same answer. And then again, the same thing for that final year of the 44,000. We're going to owe the IRS on the 56,000 times 25%. So that's our income tax payable. We're getting rid of that deferred tax asset, so we're going to credit that for 11. And then our income tax expense is 25, which also again is 25% of that pre-accounting income or pre-tax income. And then that just shows you again, we'll zero those deferred tax assets and those deferred tax liabilities out over the time that it takes to get rid of them. Then it goes the other way. So subscription revenue, where we get it in advance. So we put it into an unearned revenue account, which is a liability to us. The IRS says, well, you've got the cash, so you need to pay taxes on that. So then we're going to have to put that 80,000 on our tax return and pay the taxes on it. So then that is going to be bring our income up to 180,000. We'll owe the IRS 45,000. Then we look at the 80,000 and take our 25% of that. We've got a deferred tax asset of 20,000. And then our difference again is going to be, whoops, I went too far, is going to be what we're going to end up putting to our income tax expense. But notice again, it's also 25% of that pre-tax. Then the next year, as we earn that revenue, then we're going to take it out because then it's included in our income now that we earn it, but we've already paid taxes on it. So we're going to take it out. So our taxable income is 40,000 times the 25% gives us a $10,000 tax payable. Then take that 60,000 times the 25%, and that gives us 15, and that's what we have to credit. And then we're just left with the 20,000 for next year as our ending balance. And again, our income tax expense is the 25,000. And then we get rid of that final year. So I get that seems kind of repetitive, but you'll have to do these in the homework. So you'll have kind of one of each of them. So it's good to walk them through. And then again, shows you it's all gone. Now you could have a valuation allowance if the key to that is it more likely than not that some of it or all of it will not be realized. So say you have that deferred tax asset and we think, okay, so in this example, we think we've got $8 million in our deferred tax asset account, but we think more than likely than not, 3 million of that will not be realized. So we're gonna charge that off to income tax expense and then set up a valuation allowance, which would be like almost like a contra account to that deferred tax asset, just to bring it down to what we think is realizable. And then here again, whoops, sorry. They are showing an example of how that would be. So if we have $8 million in our accounts receivable, and I guess they're just showing you it's like a similar scenario that we then reduce that by our allowance for uncollectible accounts because we're not going to collect that. And that would be similar to what we're doing here with our deferred tax asset. So then now though, at the end of the next year, now we determine that really only 500,000 will not be realizable. So our estimates changed, something happened. So then we're going to adjust that valuation allowance and then reduce our income tax expense accordingly. Okay. Then permanent difference, those are things that are never ever taxable. So we're going to have them, again, we're following generally accepted accounting principles. As money comes in, we record it. So a major one that's the most common is, say the company invests in like local or state municipal bonds. Those are never taxable at the federal level. So if they made money on those, then we're never going to report that. So that's going to be a permanent difference between our books and what we report as on our tax returns. So here they give you a whole list. I mean, I feel like the most common is that top one. But then there can be some other ones too. So like if we had life insurance on an executive officer and they died, then the money comes in, that's not taxable, or that's not taxable. We wouldn't put that on our tax accounts. Compensation expense pertaining to some employee stock option plans might be not taxable. Fines and penalties that we pay to violate the law, they're not tax deductible. Premiums paid for the life insurance policies when the payer is the beneficiary, so those that we don't get to deduct. So we don't get to deduct the life insurance policy premiums, but we also don't pay taxes on the life insurance proceeds if it ever came into that. So those, again, I feel like are probably the most common ones. And what's that last one? Tax deduction for the depletion of natural resources if it's already fully depleted. So again, the other ones I feel like are less common. So then those we're just going to say we're not paying tax on that. Those are permanent differences. So all it does is adjust our effective tax rate that we're paying. Now then there can be times where you have these temporary differences that go out into future years and then the tax rate changes. So, I mean, that can happen. Our tax rates do change periodically. So then you just have to consider that. So as you're looking at it and you're mapping it out, you see that, okay, when we get to 2026, our tax rate is different than it is right now. So I think you do have one of those in your homework. So just be careful to notice what the tax rate is for those future years. And then you're going to set that up, though, that will go into your deferred tax liability because, again, you know it in advance. And then when you get to that year, you'll end up just taking it out at that. Okay. And then if anything, changes like unexpectedly, you don't know, obviously you want to put it into the year that change is inactive. You want to match it to the proper period. And then here again, I think they're just showing you the example of if we realize we already have this deferred tax liability, and then all of a sudden they change it and it goes down from 39% to 25%. As soon as we're made aware of that, we're going to have to make that adjustment. So reduce our deferred tax liability and then reduce our income expense because, again, the tax, in this case, the taxes went down. And then same is true of the tax asset. As soon as we realize it, but again, it'd go the other direction, that our taxes go down, we no longer have that asset to pull from, because again, we set it up at say 39%. Now we're only going to get to pull out of it at 25%. So we just have to adjust those accounts that are on our balance sheet down to truly what the balance will be. And then you can always have multiple differences. I mean, I don't know. I don't think in the homework we get into those levels, but just obviously in the real world, we could have all of those temporary differences in one year. I mean, if you're a very big company and you've got prepaid, you've got, contract revenue and you're buying equipment, you could have a variety of those in 1 year, which makes it obviously a little harder to keep track of. And sometimes, you'll have a whole crew of people in your corporate tax department, and they'll be keeping track of that kind of stuff. But again, it could be you if you like taxes. So it just makes it a little bit more challenging. Here it's showing you've got these two that you've got to account for. So your journal entry gets a little bit more elaborate, but it's still basically the same process. You're going to figure out what you owe the IRS, and that goes into your income tax payable. Figure out what you're setting the deferred tax asset up for. What are you setting the deferred tax liability up for? And then the net difference is still going to go back to that income tax expense. And then they just show that working it's all the way out. So I mean, you can look through those slides. Again, I don't think the homework has you have multiple temporary differences, but you can. Okay, then the next category is operating losses. So tax laws allow us to carry forward our net operating loss or carry it back. So we could go back to reduce taxable income in our prior years, or we can carry it forward to reduce taxable income in the future. So we have, it is a benefit to us and it does reduce our taxes. So we're going to account for that. So then here shows you if we've got this net operating loss of $120,000. So we don't owe anything in the year that we have the loss, but we're going to carry it forward. So then we take 25% of that and set it up as a deferred tax asset. So then that will end up saving us money in the future. So notice that reduces our income tax expense as we create that deferred tax asset. And then when we do have, then this just shows you it reduces the loss. So we had that loss, we've got this tax advantage, so our loss goes down because of it. Then when we go to use it, then we're gonna have $100,000 of income. We're going to take advantage of that net loss carry forward. So then we're only going to pay taxes on 20%. So then we're going to have that come as our income tax payable. We're going to take it out of the deferred tax asset, again, the $80,000 that we used. And then the difference is going to be our income tax expense. Then notice again, the income tax expense still ties to the pre-tax income. Okay, then we're going to carry it back. So then if we knew, well, hey, this was just one bad year, but last year and the year before we had income, then we can carry it back and then we can get a tax refund back. Oops, sorry, went too far. So then if we have this net operating loss of 120 million, and it's at 25%, and we're going to go back to prior years. Now, again, they're showing us that the rate might have been different 2 years ago, and then we paid taxes on that. When we carry that back, we can request a refund then. So we're going to go back and carry back the 20,000 of it to 2022. We're going to take 60,000 to 2023, and then we're going to carry forward the remaining 40,000. And then again, the tax rates are a little bit different between those 2 years, so we got to use the correct tax rate to create that refund. And again, that refund is going to set up a receivable because the IRS is going to owe us. We're going to end up with our deferred tax asset for the 40,000 that we carried forward, and then that times the 25% gives us the 10. So we'll create that deferred tax asset as our debit, and then our credit to income tax expense will be the difference between those two. And then again, you see that income statement will show the tax savings, which will ultimately reduce the loss that we record. And then our balance sheet, we will have those deferred tax liabilities and those deferred tax assets, less any valuation allowances, classified as non-current assets on our balance sheet. If we have let's see. I guess this is just talking about the different jurisdictions, so I don't think we worry too much about that. And then everything is always disclosed. I mean, I always leave these in here, but just know that for a publicly traded company, everything is disclosed in the notes to the financial statements so that any interested user can read all about the deferred tax assets, the deferred tax liabilities, any changes in the valuation accounts, what are they carrying forward from a net loss standpoint, you know what I mean, and what that creates. Okay, so that is our accounting for income taxes.